Okay. All right. Okay. We are going to deal with IS1, which is presentation of financial statements, right?
Yes.
Yes. And actually, there is a lot to go through, but I think the theoretical point, of course, is very normal. It's totally normal, but maybe you'd have to resort to solving. Simply speaking, we know that in accounting or financial reporting, we have something called the accounting cycle. Accounting what? Accounting cycle. And when you do have the accounting cycle, it means we always start with with the source document. Source document like the invoices or what, the receipts, right? Source documents,
Yes.
we record them in the books of prime entry. Books of prime what? Entry.
Interesting.
Yes, or we call them the day books. After there, we take them further to the ledgers. You get the what? The ledgers. After the ledgers, it's from where we can extract the trial what? The trial balance.
Trial balance
The trial balance will have the year-end adjustments, and ultimately you prepare the financial what? Statements.
statements.
So here we are dealing with what? Presentation of financial statements. We have like 5 sets of financial statements, right? Statement of financial
Okay.
income, statement of profit or loss and other comprehensive income. That's number 2. Number 3 could have statement of changes in equity, right? Number 4, statement of cash
Okay.
flows, and lastly, note to the financial what? Statement with comparative periods. Yes. So in presentation of financial statements, of course, we will not deal with statement of cash flows. Statement of cash flows is dealt with aside in IS 7. But for this issue of diploma in IFRS, it is not in the syllabus, so we won't deal with it. Of course, if you wish, you can just
Okay.
share the link, but you don't have to cover it right now. Okay.
Okay.
Okay. So it's just the normal principles, as you would see. Have you ever prepared the financial statements, or have you ever seen how they do appear?
Yes, I have an idea of the balance sheet and the profit or loss.
That's good. That's good. Okay, so that's why you're told now on presentation of financial statements, we have the objective. Main objective is describe the basis of presentation. How do you start preparing, right?
Okay.
So it explains all that, and it set the overall requirements for presentation of what? Of financial statements. Of course, we're going to see all that, right? Uh, in this one, you will see the scope. We have to know the scope of. And by the scope, what do we mean? Who should use IS1? Right. It applies to all general purpose financial statements that are prepared and presented in accordance with IF what? IFRS, right? Also
Yes.
general purpose financial what? Statements. There could be some statements which are specific, maybe, right? So you have to resort to
Yes.
the item. So this is just for general. And the general purpose financial statements, what do we mean by them? They are those intended to serve users who are not in a position to require financial reports tailored to their particular information needs, right? That's what we mean by this point now, being more specific. Okay, maybe I need the financial statements that explain deeply on how lease accounting was done. No, you just have to take the general statements and use it, right?
Okay.
Yes.
Okay.
Okay, then let's look at the objective of financial statements. The objectives, of course, we prepare them because they have financial information that users could what? Could benefit from. It could help them make informed decisions, right?
Yes.
It's just a normal point. And then I say to meet that objective, actually, that's why you'll see statement of financial position will have assets, liabilities, and what? And equity. You say the
Yes.
income statement, which will have income and what? Expenses, right?
Expensive. Yes.
But also you're told contributions by and distributions to. Contributions by owners of the entity, those are the capital. It's the equity, of course, they're the capital, right? But
Okay.
distributions to, it's like shareholders have contributed, but maybe you're going to pay dividends, so you're going to pay them, right?
Okay.
Yes. Then speak of cash flows. Of course, you're not going to do the statement of cash flows here, like I told you, right? So I
Yes.
general thing you should what? You should understand. Components of financial statement, you have spoken about them. Statement of financial position, also called the balance what? Balance sheet, although with
Balance sheet.
the term of financial position, right? And
Yes.
statement of profit or loss and other comprehensive income, or you can just say statement of comprehensive income. You omit this word other, and then you say statement of what? In this one, statement of comprehensive
Of,
income.
okay.
Because even profit
Okay.
loss is a comprehensive income too. That's why you say profit loss and the other comprehensive what? Income.
Okay.
Then statement of changes in equity. So we'll end up here. Statement of cash flows. I told you it's under IS what? I7. So we're not going to
7.
this. Yes. And then notes to the financial statement, which is common, of course. You must disclose some information, even if you did not recognize, right? There are
Yes.
types of information which you have to disclose, even if you do not what? Recognize.
Recognize.
But even those you recognize, you need to give the details. So you would just find yourself having the notes to the financial statement. Okay, you're told here, additionally, comparative information is prescribed by the standard. Of course, that's why I said if you do prepare the financial statements, maybe you'd have maybe 2014 and 20 what? 13. That is just an example, right?
Okay. Yes.
14 and 2013. So you could have something like that. And that's why you're speaking of what? Comparative information. An entity may use titles, let's say, for the statement other than those to the above. But all financial statements are required to be presented with equal.
You're very low. I can't hear you.
Now,
Hello?
hello.
Hello? Hello? Hello?
Yes, hello. 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 Hello.
Yes, you had gone. I was not hearing you.
I don't understand why this is happening. I don't understand. I haven't changed the thing, and I was still. Only my mouth was shaking. Only my mouth was actually moving. Right. I don't know. I don't know
Yes.
what happens. I don't know. Hey. I see. I think I will have to start praying more and more. I don't know what is happening. I don't know. Hey, I also see that's what right now I can be visible. Maybe, maybe,
Yes.
maybe there is a background application affecting me. I think I should try
Maybe
to
you
take.
need to take to someone, the IT person,
No, I'm
to
I'm
check.
I'm the IT person myself.
Oh,
Yes,
really?
I even installed these windows. This window I'm using, I usually install them. So
They say a doctor cannot treat themselves.
I actually don't. That's why I was being amazed. What's this? And right now it's fine. It's fine again. I can see myself being heard.
Yes, you had gone when you see the last the last words were like, we are not going to learn about statement of cash flow, and then you wait.
Okay, that's fine. Okay, let's proceed. So whenever it just gets slow, just let me know. Right, I'm recording this. Okay.
Okay.
Okay, so we are not going to study the statement of cash flows, but we'll deal with not the financial what? State. Of course, these ones come
Statement.
obviously when we do study the standard, right? Okay. The other thing
Yes.
now, there is an issue of comparative information, right? Whenever
Yes.
you prepare this statement, let's say statement of financial position, you would have maybe this is for 2024, but you would have the comparative year, which would be 2020 what? 2023, right?
Yes.
Yes, you would have them all. And usually we like to put the latest year, it's not like this. People may like to use the latest year because you'd have maybe it is the income statement, you would say revenue, right? You'd write here what?
Yes.
Revenue. So what faces revenue, what is adjacent to revenue should be the latest year, and maybe the previous years could come here as you wish. 2023, let's say 2022, if you do have 2021. Of course, people mostly only use a single comparative period, right?
Yes.
But you're not limited to that. So that's why I say an entity may use titles for the statement other than the one stated above. Instead of saying statement of financial position, for example, maybe someone could have said the balance sheet, right?
Yes.
Yes, of course, that would be understood, but these are the common ones, and I suggest that we should be dealing with these ones, right?
Yes.
Yes, I really do suggest that we focus on those ones, right?
Okay.
Now, maybe the other point that we can speak of here is that when an entity applies an accounting policy, like you have seen retrospectively, you do remember about AS8, yeah? We said that the changes in
Yes.
accounting policies are applied retrospectively. You go back as much as possible. So when an
Yes.
entity applies accounting policies retrospectively or makes a retrospective restatement of the items in the state financial statements, or when it reclassifies items, right?
Yes.
The financial statement must also present a statement of financial position. Balance sheet is at the beginning. We learned that yesterday, right? You say that you have to present
Yes.
at the beginning of the earliest period presented. Do you remember this statement?
Yes. I
Oh, this
remember.
one. Yes. Earliest period what? Presented. Good.
Isn't it? I still remember. Whereas we need to start instead of starting on 31st December, we start on 1st January.
Yes, good. Okay, the other
Yes.
point here, here is just you just need to get some knowledge. Okay, it is this way, and this way. Not much. Much would be on solving the questions. Okay, reports that are presented outside the financial statements, for example, maybe the financial reviews, for example, maybe by management, maybe environmental reports, or maybe the value added statements are outside the scope of what? Of IFRS, right? Of course. For example, these days you may even find sustainability reports, corporate social responsibility reports, things like those, right? Of course, they are not explained by S1. That's what we are saying, right? We do not use S1 to explain them, okay? Then let's go to other considerations too. There are also normal matters that you would always encounter in the financial what? Statements. Okay, number one, fair presentation and compliance with IFRS. You need to understand about this term fair what? Presentation. Of course, I shouldn't go so far explaining this. Simply speaking, when we speak of fair presentation, we say that whenever you comply with IFRS, right, we presume that you have presented the issues fairly. So because we believe that the IFRS have been prepared in such a way as to guide entities to do well, right? To have proper presentations, yes. So if you do comply with the IFRS, we presume that you have also complied with what? With the IFRS, but also you have made fair what? Presentation. That's why we say here the financial statements. Yes, the financial statements must present fairly the financial position, just a statement of financial performance, which this is a statement of profit or loss and other comprehensive income. Way. Sometimes called statement of financial and performance and the cash flows of an entity. Fair presentation requires the faithful representation of the effects of what? transactions, let's say it's
Transactions
other events, and the conditions in accordance with the definition and recognition criteria for what? For assets,
for
liabilities,
assets.
income, simply speaking, for all items included in those statements, right? It is specified in
Yes.
the conceptual framework. There is a conceptual framework that explains all these definitions. Of course, conceptual framework is just a guide. It's not something that you must comply with, right?
Yes.
So simply speaking, just mere compliance to financial statement, IFRS, means that is presumed that entity has made fair what? Presentation. I hope you got that,
Presentation.
right? Yes.
Yes.
Okay. You can see this is the good point. I like to spot this last point. It says inappropriate accounting policies are not rectified either by disclosure of the accounting policies used or notes or explanatory material. You cannot say that, okay, you have gone against the accounting policies and then you are saying, okay, no problem, I've not done well, but I'm going to disclose. People are going to know that I did this. That won't help, right?
Okay.
Yes, you need to comply. You comply as required. Not, okay, you do something which is wrong and then say, okay, I'm going to let them know. No, this isn't proper and
Okay.
you should not do that, right?
Okay.
So let's go to another point, going concern. Going concern, of course, the conceptual framework defines it as it is kind of an underlying what? Assumption. You know, going concern, we presume that the entity will continue to operate for the foreseeable future. You get this point? The entity will continue to
Yes.
operate for the foreseeable what? Future. So
Future.
maybe that's why you could have, you say these assets are current, these assets are non-current, these liabilities are current, these are non-current. It means you still expect them to work. Because if you had an entity which maybe you said it is going to be liquidated, right?
Yeah.
And so it is going to be closed down maybe in 4 months. We wouldn't have any non-current component because non-current component should stay for over a year, right?
Yes.
So by going concern, we presume the entity will operate for the will continue its operation for the foreseeable what? For the foreseeable future, which we normally presume to be the next 12 months. It will still be there. So simply speaking, an entity under liquidation is not a going concern actually. Right. So what do
Okay.
we mean? By
Yes.
going concern, there are two major reasons, right? It is either an entity has just decided to stop operations of the business, maybe to close another business, to open another business, they see, to close the first business and open what? Use the funds to open another
Another
business.
business.
Or maybe they're in a bad financial position that they are insolvent. They have undergone bankrupt, right? So
Okay.
there is no way they're going to be closed. And by undergoing bankruptcy, it means that maybe you could find an entity having a negative equity. Equity equals to assets minus liability. So by equity being negative, it means liabilities exceed assets, right? Imagine
Yes.
a company like that, its liabilities exceeding its assets. You get that? Yes. So it
Yes.
will be that way. So that's why in the definition of the going concern, we usually say that going concern is when an entity has neither neither what? Need,
Need.
nor intention to liquidate or curtail materially the scale of its operations. Right. Simply speaking, I'll start speaking of these two last matters, curtail materially the scale of its operations or liquidate. If you do liquidate, it means you close down everything, right? So that is
Okay.
obviously a
Yes.
threat to going concern. But maybe you could imagine you are having like 50 what? Let's say 50 business units, for example, and you are going to close 48 business units. Doesn't that threaten a going concern?
It is.
Threatens because you can see that we have materially curtailed the scale of operations from 50 strategic business units to only two. We have curtailed the scale of operations, right? Without
Yes.
continued existence of this company, right?
Yes.
But now you also have to understand this by saying neither need nor intention. Intention, it means the company is financially well, but maybe it has just decided to close this business, so it's open another. But if you speak of the need is, although the company doesn't have the intention, but it has no way, it has no alternative. That's why you have voluntary and involuntary liquidation, right? If something is voluntary, it means the company has just decided to do it, right? But if it is involuntary, it is outside control of the they have.
Hello?
Yes.
Hello? 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 I can't hear you, sir.
Hello? Hello?
Now you've come back. Yes, now I can hear you.
There is something here. Maybe I'll start to deal with. Okay, it can't. It just goes off. You let me know again, right?
Yeah, okay, sir.
Okay. All right. So, it's just like I've told you about the going concern. It could either be voluntary or non-what, or voluntary or involuntary. Okay, that's the main aim of going concern. So usually when you do prepare the financial statements, we presume that the company will be a going what? Concern. So against that, in case that is it, the situation, we have to explain. It has to be explained, right? For example, maybe the company is going to be liquidated. The company, maybe there is bankruptcy. There's an issue of bankruptcy, right?
Yes.
The statement will be prepared on a breakup basis, and they're being prepared on a breakup basis that the items will be sold, will be settled at piecemeal values. All non-current assets will be current, all non-current liabilities will be current liabilities, and even their values would be lowered. The aim there is just to sell faster as quick as possible to settle the obligation,
Okay.
right? Yes. So
Yes.
that's what we should do. That's why you say IS1 requires the management to make an assessment of an entity's ability to continue as a going concern. So when we do prepare the financial statement, the company should judge about the next 12 months whether the company will continue to operate. If it says yes, then it says, okay, we have a going concern and we measure our items as we usually do. But in case we see that
Okay.
no, we are not going to last the 12 months, we say, oh, we don't have to use going concern, we have to use the breakup basis, right? And if you use the breakup basis, you
Okay.
must disclose that so that users of financial statements know what is going on with the entity, right?
Okay.
Yes, that's something like that. Okay, let's go again. We have the accrual basis. What do you understand by accrual basis?
Accrual. That's the term accrual.
Accrual,
It's a
Mhm. It's a what?
accrual is a transaction that needs to be like you recognize the transaction before you make a payment or you receive a payment.
That's the meaning of
But
accrual.
it's
So
something that you are obligated
I got your
pay
concept.
in
Good,
future.
good, 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 good. No, no, okay. This we are speaking of the way the accrual basis, right? Accrual basis.
Yes.
The accrual basis in the concept itself is like when you are doing business, you expect to receive funds, money in and
Yes.
money out, right?
Yes.
Of course, when speaking of money in, it means that maybe you have sold goods to someone and they have to pay you. So you have earned something. For example, I'm selling oranges, right? If
Yes.
I successfully sell oranges, even if I've not received the cash, I would say that you have made revenue and I'm going to recognize revenue, right?
Yes.
Okay. Let's say that I'm staying, maybe I've rented a shop sell my oranges. A month passes, and maybe my rent there is $100 a month, right?
Yes.
If a month passes, even if I'm yet to pay the landlord, I would say that I've incurred the expenses of 100 what? dollars. That's what we speak
Dollar.
of. So revenue is earned, right? We recognize revenue when earned, even if not when received. Cash is received. And we recognize expenses when incurred, even if not yet paid. Just like you're
Paid.
saying, right? So it is just
Yes.
against the cash basis. And financial statements are prepared on an accrual basis, income statement and statement of financial position. And this is the reason that we usually prepare the statement of cash flows, right? Because
Yes.
this doesn't, you could look at the company and it could seem like it has a lot of profit, but in reality, it doesn't have cash. Have you ever seen that? You find a company has a
Yes.
profit of 1 billion, but if you go to cash, it maybe it has only the overdrafts. It owes the bank
Yes.
in both the short-term and long-term funds. You go to the trade payables, it owes suppliers. A mess, a total mess, right? Which usually in
Yes.
that situation the company could be deemed as overtrading. That it could look like it is trying to convince customers to sell goods to them, maybe for longer credit terms, so that customers just come and buy, but there is no guarantee of receiving the funds, right?
Yes.
Yes, so this is what we speak about accrual basis. I hope you got that.
Yes.
And now let's go to consistency of presentation. That's just a normal point. When we speak of consistency, we focus on the comparability. You need to be consistent on your presentation of financial statement. Do you remember about
Statement.
accounting policies? We spoke of it yesterday. We said when you choose the presentation, let's say depreciation stays on cost of sales, you should be consistent over the years, right? Not this year, you
Yes.
put in cost of sales. Next year, you put in administrative expenses. That one would be wrong. So you have to be consistent in
Yes.
your application, right?
Yes.
Consistency helps to actually comply with comparability. It would help you when you want to compare financial statements for say for different years, right?
Yes.
Okay. Then you have another point here: materiality and the aggregation. You get the point. Let me tell
Yes.
you one thing. Whenever you prepare the financial statements, and again, I'm repeating, financial statements are prepared based on materiality. If something isn't material, there is no point including it, right?
Yes.
Because, we prepare them for stakeholders, which the main aim we usually go to those fund providers, right? Investors,
Yes.
lenders, and other creditors. That's the main goal. This world is so biased. Even in financial reporting, they tell you that the main aim is for investors, lenders, and the other creditors. They don't mention they don't directly mention other people, but customers, they don't do that. They just look at those people who enable them, who fund their business. Okay, so that's materiality and
Yes.
aggregation. What we mean is when items are not material, they may be combined together to form a single item, which can then be presented, right? If you have ever seen,
Yes.
for example, in statement of financial position, have you ever you can sometimes find something written as sundries. If you'll find something
Yes.
on
Yes.
sundries,
I've seen
yes,
the expenses.
yes, even expenses, little items combined into one thing, and we call it sundry expenses, for example, right?
Yes.
Yes, that's what we mean by this. So that's why I say information is material. Just like I told you, something is material if it can influence economic decisions of users of financial statements, right? So
Yes.
that if it's omission or misstatement, if you omit it or maybe you give it the wrong figure, could actually change the decision of the primary users, which I told you that they are investors, lenders, and the other creditors, right?
Creditors.
So
Yes.
each material class of similar items must be presented separately. That's obvious. If something is a material, you shouldn't combine it with others. You present it separately, which is the normal concept in the financial statements. But look here,
Statement.
the similar items may be
Items.
aggregated only if they are individual immaterial. Items are not similar, right?
Yes.
But you may still be allowed to aggregate them if they are not material, because even if you present them line by line and users come, they wouldn't derive anything from that, right? They wouldn't get any
Yes.
insight which would enable them to make their decisions, right?
Yes.
Okay, and then we go to aggregation. Now we speak of it, yeah. However, information should not be obscured by aggregating or by providing immaterial information. You get it?
Yes.
Materiality considerations apply to all parts of the what? Of the financial statements. And even when a standard requires a specific disclosure, materiality considerations do what? Do apply. So
Apply.
that's what we should just base on this, all right? So you should be careful not to over aggregate matters, right?
Okay.
Okay, then another point here we speak of offsetting. Okay, offsetting, I could give you I don't know which example I should give you. Let's say you have an asset of 10 million, but maybe that asset is associated with a particular liability of 6 million. Let me tell you, for example, there's a standard called financial instruments. Yeah? Presume that maybe
Okay.
you borrowed money from the bank so as to invest in an asset that people would come and borrow from it too. You borrow 6 million to invest 10 million on the same thing, right? So
Yes.
some people could say, okay, in this case, maybe, maybe when in case there are other matters that have been explained by the standard are met, maybe you can be allowed to offset. I'm just giving an example, right? But now,
Yes.
to do this, the standard itself must have spoken about that. You shouldn't do it by yourself. I could give another example. Let's say you see about these employee benefits. The employee benefits, there could be a pension scheme prepared, right? At which maybe
Yes.
the employees usually contribute. They make their contributions. Yeah. So those contributions
Yes.
are invested and form assets, right? But the company
Yes.
has that. The company could have a pension plan, but actually, it has to pay the employees, right,
Yes.
for their pension. So it also has a liability. So you can see, so you can have a plan asset, but pension plan asset, but also a pension plan what? Liability. That standard
Liabilities.
specifically allows to net these off. So you can take net of assets and liabilities. If you have net assets, we present this as assets. If we have net liabilities, we present this as what?
Liabilities.
Liabilities, right? Yes. So that's what we would do. But offsetting, we say assets and liabilities, but also income and expenses may not be offset unless required or permitted by what? By an IFRS. You see that? The standard
Yes.
allows, you do it. I could give you another example. You have done government grants. You remember about government grants?
Yes.
We say that if you have an asset, you purchase an asset for a certain amount, and then you have the government grant, which you could we could prepare a loan. It's deferred what? Deferred income. You do remember that?
Income. Yes.
When we are
Deferred
doing
income.
that, we said
Grant liability.
yes, grant liability or deferred income. So we say that if you use an asset, you could deduct the grant from the cost of an asset. You see that?
Yes.
So it's like we had netted them off from the very what? Very beginning. But this is only done
Beginning.
if the standard allows such a thing. Right.
Okay.
Yes. So I hope you have gotten the limelight
Yes.
this offsetting really means, because what matters here is that you have to dive into the practicalities of something. Okay, then we have something called comparative what? Information. Comparative information, I think you have spoken about it already, right? When you do have maybe
During the presentation, yes.
yes, you could also
Of the statement.
the previous years. Okay, that's good. So nothing much.
Hello.
Yes, yes. I can hear you.
You are very low. I can't hear you.
Hello.
Now you've come back. Now I can hear you.
Okay, I'm back. Okay, that's good then.
Yes.
So you can see here we have the note here, right? look, you have this note, you are saying, IS1 acknowledges that in extremely rare circumstances, management may conclude that compliance with IFRS requirements would be so misleading. You know, there are that situations, right? You try to comply as much as possible, but you find it that, oh, this one is misleading, so that in such a way that it would conflict with the objective of financial statement set out in the framework. Right. In such a case, what
Okay,
does it then do? It tries to comply, but it goes against this one, the framework. So in such a case, the entity is required to depart from the IFRS requirement. It can decide what? To depart. It can
depart.
limit the IFRS requirement with detailed disclosure of of the nature, reasons, and the impact of the what? Of the departure. You see that?
Departure.
Yes. So it could be allowed as long as you see that, okay, what isn't right. And okay, we still have about for profit or loss for the year. I think too, we don't have much. Yeah, you know about the profit or loss for the year, right? Income
Yes,
statement, the revenue, the cost of sale, the gross profit, the operating expenses, the finance cost, maybe the taxes, the profit for the year, and then the other comprehensive income, just normal. That's why I told the statement of profit or loss and other comprehensive income is most significant indicator of the company's financial performance. This is obvious. Yes. So it is important to ensure that it is not what? Misleading. There is nothing important here actually. I hope you got the point right.
yes,
Yes. You can see circumstances where maybe items may be excluded from the profit or loss for the current year, include maybe the correction of errors and the effect of changes in accounting what? Policies. If you have the prior period errors, like you saw yesterday, right? And the change in
yes,
accounting policies, those one apply for the previous years. I told you, if it is a correction of current period errors, obviously you will affect the income statement. If it's for the current what? For the current year. Get that. You got that, yeah?
yes.
Okay, so that's cool. And we are told how items are disclosed now. How items are what? Are disclosed.
Disclose.
Yes, ISWAN specifies disclosures of certain items or in certain ways. For example, let's say some items must appear on the face of statement of financial position. We would see these ones, or profit or loss. Like let's say the sales, the cost of sales, you will see them, right? The assets, the liability.
Yes,
Yes, you're going to see that. But maybe other items can appear in a note to the financial statements. Like you saw maybe on A37 provisions, contingent asset and liability, that contingent liabilities, if material, may only be disclosed, such kind of things, right?
yes,
Have the recommended format that which are given for which entities may or may not follow depending on their what, on the circumstances. So there are just matters that you would see when you are actually dealing with what, with the solving. And then what next is the structure and content of financial statements.